Ladies and gentlemen of the crypto space, we're live on Wednesday, December 20th at 11:30 a.m. Bitcoin applications? What? Are we talking about ordinals and the transaction fees that are going on Bitcoin and the mining revenues? Is this what we're talking about? Isn't there something bigger? Is something bigger at play? So I've been posting last night and today a lot about Bitcoin because it's not understood. The systems that we have are very much glossed over. People look at the surface, people look at charts, price points. But what we do here on this stream is connect the damn dots. There's a whole set of things going on that are not first layer inspections. Second order effects, knock on effects. What does it all mean? So, price point of assets means it's useful as a money. To what degree it's useful as a money has to do with liquidity and capacity to facilitate settlement. So, if you have Bitcoin and you could, within 10 seconds, within a minute, liquidate it for some sort of dollar liability, finance a debit card purchase or transfer it to a destination to achieve settlement, then it's pretty useful because the whole point of assets and money or being able to define things as money is that you can purchase things that you need. Food, gas, pay a bill, pay a credit card, pay a mortgage. All right, great. So that's on the surface, the inspection of Bitcoin and the never-ending argument between Bitcoin and Ethereum folk with regard to consensus. So sure, that is an argument that's meaningful. Proof of work versus proof of stake, and the plethora of derivatives of proof of stake, and what occurred in 16 and 17 with the insanity of proof of work, and folks trying to figure out what all of this means. In the end, there's hash rate, and there's incentives to finance that hash rate. Now, proof of work does it a little bit differently than proof of stake, and that's an entire conversation unto itself. But what's pertinent is the security that is achieved. And you could argue to wit's end about the degree of a security that's achieved, but there is security that's achieved. Now, that security is very useful. And that's what we're talking about here today, ladies and gentlemen. The security that's available and what it can be used for. So everyone looks at a crypto space and they immediately have their attention drawn to the price changes of assets that are spread across EVM chains. Now, obviously, Solana as well. And Cosmos hubs are not dismissed and is popular amongst the large community. But Solana's been really hot lately. Polkadot is still on the back burner as well, much like the Cosmos hubs and ecosystem. But Solana's been hot. Now, Solana has characteristics just like Bitcoin, and we have conversations about transactions per second, and we have conversations, do you need an L2 with Solana? Do you need an L2 with something with a relatively high transactions per second? Not necessarily. And that's an interesting conversation. Bitcoin has very low transactions per second, and you most certainly need an L2 to interact with Bitcoin from an application standpoint. Now, the whole point of this stream is how hot transaction fees are and hash rate is on Bitcoin, and the price action, it's leading the entire market. So the hash rate, what could it be used for? The hash rate of Bitcoin is useful for security, just like the security that is achieved using Ethereum proof of stake consensus. Now, it's not as popular historically thus far. There's very little occurring at the applications layer that layers that have been built for the Bitcoin network, and you have this tremendous amount of activity from an ordinals perspective, which in these BRC20s, which is very, very, very L1 centric. L1 as in, it's kind of like you're looking in a DOS terminal and interacting with shell prompts. It's not conceptually like you're interacting with a relatively high level programming language with a robust user interface, and the output or the user interface is able to abstract the L1 interaction, storing data in compressed formats as required, and L1 being used for storage. In this instance, state management with regard to applications. So that exists for L2s on Ethereum, Optimism, and Arbitrum. Obviously, they call them roll-ups of sorts. And it rolls up the data, it compresses it, it abstracts it, and it creates a payload that's ultimately stored at the L1 level. Now, this can occur and is built thus far to occur for Bitcoin as well. There's four primary, let's pop it over to the main screen. Now, let's see some content other than the Ethereum price. That's completely off topic. There's four primary L2s, so to speak, and that's an interesting conversation that Stacks talks about very nicely in some of its articles. There's four primary L2s for Bitcoin. Liquid is old school, basically has little to no activity, very closed ecosystem, and is very payments oriented. They focus very much on the money aspect of Bitcoin. Stacks doesn't use EVM. It has a different language, scripting implementation, other than Solidity, and ultimately all of these do something similar. But Stacks, it's like they talk about roll-ups, and ultimately they store their application state directly to Bitcoin. Syscoin and Rootstock, to my understanding, have a degree of abstraction in between, just pure inscription or storage of application state to L1. They have their own networks in between, but ultimately, the culmination of all four of these protocols, Syscoin, Rootstock, Stacks, and Liquid, is the use of Bitcoin hash rate for security purposes. Now, that's extraordinary because you could have the argument about the money aspect of Bitcoin versus Ethereum all you want, but the security that Bitcoin mining, proof of work mining, and Ethereum proof of stake offer is not, it's distinguishable, but it's indistinguishable in regard to the capacity to secure application state. All of this leads to the argument that the EVM and the applications that people typically refer to on Ethereum, clearly they're on Avalanche, clearly they're on Arbitrum, clearly they're on Optimism, so on and so forth. Syscoin and Rootstock are EVMs. So and Rolex made by Syscoin is an Optimism rollup, just like Optimism is for Ethereum, that is perfectly EVM compliant, which means you can literally deploy your EVM application. If it runs on Optimism, it'll run on Rolex. And the difference being, it's literally secured by Bitcoin hash rate. And that's big. That's meaningful because now you're turning the applications that we have been playing around with, tinkering with, and speculating on into something that's not just secured by proof of stake and those types of consensus algorithms, but now secured by proof of work and the entirety of the Bitcoin network, which so many argue is more secure and censorship resistant as compared to what we use at the Ethereum level. Very big distinctions between Syscoin, rootstock, stacks, and liquid. I think from an interesting perspective, what is most interesting to me is Syscoin and rootstock being completely EVM compatible. At one point, multi-chain, the now, you know, evaporated multi-chain, had Syscoin and rootstock implementations. You could bridge assets from Ethereum or whatever integration they had at the time to Syscoin and rootstock. That was the start, and I thought that was going to be the start of something more meaningful. But this is way before ordinals took off in any regard. As of right now, there's no industry accepted, industry comfortable liquidity bridges available. And that is a gatekeeping activity on these Bitcoin L2s, which that's what we could classify all of these as. So what does that mean from an opportunity standpoint? What does that mean from a technology standpoint? It means every application you've ever interacted with can be deployed on Bitcoin secured Ethereum virtual machine networks. You could deploy Curve. You could deploy Uniswap. You could deploy Layer 0 and Stargate. So the infrastructure is there for everything that we've done thus far to be done being secured by Bitcoin, and that's meaningful. I don't have a capacity to speak from an opportunity standpoint. I guess maybe Stacks, STX, and Rootstock doesn't have some sort of incentive regime. Syscoin does, obviously, with its Sys token. Then this Syscoin's been around since like 2017. This thing has been around a long, long time in crypto time frames. So I favor Syscoin and rootstock versus stacks and liquid, and I favor Syscoin versus rootstock because of the infrastructure they have and the optimistic rollup implementation they have with Rolex, Rolex.com, if you're interested. And that is what it is from a technology standpoint. Now, my sentiment with regard to capital management, portfolio management, is I don't give a shit the chain. I care about security very much. I care about money and value, so that's why I denominate the cash position in Bitcoin, Ethereum, and stablecoins. I care about the usefulness of money. I manage the volatility of money. Great. But with regard to applications, they're enterprise. It's the entire conversation we've been having for these years. And what is the enterprise? The enterprise is credit. The enterprise is FX, foreign exchange. That's it. That's what these systems are, and gaming and shit. But I would favor like Immutable for something like that. So these credit systems and these FX systems work just the same on these Bitcoin secured EVM chains, and that's really cool. That's very interesting. What that means is we have front run the deployment of these credit and FX businesses to these Bitcoin secured EVM chains. It doesn't, when you're investing in certain protocols that are established and very fundamental and very infrastructure like, you're not tied to a particular chain. And you have a great foreshadow with the history thus far for these businesses to have been deployed to things like Avalanche and things like Optimism and Arbitrum and Phantom. Solana's a complexity, and I'm unsure why we have, well, frankly, the liquidity connection between Ethereum mainnet and EVM compatible chains to Solana has improved significantly over the last months, especially given the activity on Solana. But I would expect all this capital, all this liquidity, availability in Ethereum and EVM chains to probably want to find its way to a Bitcoin secured EVM implementation at some point. And to top it all off, you have the capacity for not just that cross-border capital flow. that exogenous capital flow, but you also have the potential for endogenous uh, capital creation. So it's a Bitcoin secured EVM chain, so there's probably an increasing likelihood for Bitcoin to find its way in a trustless kind of way. You know, it involves MPC or potentially atomic swaps like BTC Garden and Catalog Finance are starting to roll out, which is they were originally going to use REN, but now they're just using atomic swaps, and swapping to WBTC. But there's no reason these types of implementations can occur on a Bitcoin secured EVM network. There's no reason. And what is absent on these EVM chains, these Bitcoin secured EVM chains, is the incentives. What triggers the behavior we've seen thus far on Solana is the second you see an incentive system that's deploying like 1,000 or 10,000 dollars worth of an asset, you see large percentages on an LP because there's $0 or $0 worth of value in the LP. So you're going to see a 500,000% APR. Of course, if there's $10 in the LP and you have $20,000 or $100,000 worth of incentives, yeah, you're going to see those insane kinds of numbers. And as a result, you're going to see opportunists want to take advantage of that. So what has been missing thus far, I speculate, for Syscoin EVM and Rootstock EVM is a powerful incentive regime, which we define nowadays as federated recycling regimes, federated currency producers. So that'd be very interesting to see forks of those protocols, or even just a deployment of those protocols as voted by the respective DAOs as required. And you really need the liquidity bridges. So I'd really love to see like a layer 0 Stargate implementation. For one, Solana. For two, for Syscoin and Rootstock. There's no reason they cannot be integrated. The thing is, it's just cost-benefit analysis. It's going to cost X amount of work hours to deploy to those chains, and if you're not going to be making any returns because there's no financial activity, so it's very much a chicken and the egg type situation. And that's the way it always is. But what brings us back to this conversation, which has been on my mind for years. I've been eyes on Syscoin and Rootstock for years, and then I've noticed Stacks. It's the ordinals behavior and the amount of transaction fees and volume that's going on Bitcoin L1. And at some point, what happens every goddamn cycle with Ethereum mainnet? Everyone's like, this shit's too expensive, and you're going to use Optimism and Arbitrum. That same exact thing's going to occur with Bitcoin. If they continue to use Bitcoin the way at an L1 level, the way they've been using it, it's too expensive. It's not efficient, and they're going to be like, let's start using the L2s. Isn't that inevitable? Isn't that happen every cycle with Ethereum being expensive and that pushes everyone to the L2s? So, all right, Bitcoin's getting pretty expensive. And even like Maximus will say, all right, stop using L1s and start using the L2s that are secured by Bitcoin hash rate. And the whole system as a whole will trend towards pushing this financial activity to Bitcoin secured L2s, which includes Stacks. So Stacks is like a Solana, and a Syscoin is like an Ethereum, and a Rootstock is maybe like a Phantom. It's just an Ascent. It doesn't have traction yet, but it's still an EVM. So you could draw these comparisons to compartmentalize and put the puzzle pieces and draw a picture of how the things compare to existing widely used infrastructure. And you could speculate as to what may become of them. Let's move this back over, put this here. And as you can see, there's been a lot of activity. Stacks is up a whopping, it broke out from the 564% massive cup and handle. It's a big breakout too, 30% rip to the upside on a daily. So that's big appreciation. But I wouldn't, from a price action standpoint, that's clearly off my radar. I'm not buying anything at a premium like this. Look how deviated it is from the monthly time weighted average price. So that's completely invalidated from consideration just by those fundamental rules. Now, Syscoin isn't. It's a 61% premium from bottom. It's just pushing through the time weighted average price on the monthly. Has history back to 2017. This is a relatively recent chart. But all these charts are very similar. You can see the similarity between even AVE, big action in 2021, bottom push through time weighted average price. See the same thing in DOT, big action, bottom push through time weighted average price. Even Solana, big action, bottom push through time weighted average price to the upside. So I mentioned the tweet yesterday. You're not buying things that are up. You buy things speculatively when they haven't moved yet and they haven't caught anyone's attention. And that's just the only way to manage a portfolio rationally, because if you're buying something that's up, it has the potential to mean regress. Yeah, if you have something that completely mean regressed and deviated to the downside and mean regressed from the downside back to the average price, that has the potential, much more potential, to start deviating to the upside from the average price. Anything that's already deviated to the upside has a potential to mean regress to the average price to the downside. So this has nothing really to do with the way I've managed things over the last years, because I'm just a long-term bag holder of Syscoin back to like 20, I don't even know, or maybe 2019 at the lows. So I have a positive number for Syscoin from 2019. February, March, April, something of 2019, but I've known about Syscoin since 2017. Bag holder in the house. That's just the way it is. But it's interesting. It's interesting to see the ordinals activity. It's interesting to see the way Stacks responds. STX, the asset, which is the incentive regime, and it's garnered a lot of attention. And even Syscoin. Syscoin is off its lows. It's got positive attention, 5%. You get a rip of 20% to the upside. You get a breakout from a technical perspective, and it just runs for technical reasons. And then the narrative of it catches up to Stacks because they're all, Bitcoin secured smart contract networks. But you need the infrastructure to really get that uh, robustness of financial activity. To get the credit applications to move over, get the FX applications to move over. And it's now like, it's just, it boggles my mind how people from look at these markets. It's literally just a hot ball of money. I'm sure you've heard that terminology. And they go from chain to chain, and it's the same fucking protocols over and over again. It's credit and FX, credit and FX. It doesn't matter which chain you're on. It's just credit and FX. And if it rips to the upside for technical reasons, you can outperform. And the whole meme coin thing where you're getting 10,000% returns in a week, that's a whole nother story. So I look at these types of things. I look at technology. I look at infrastructure. I look at what is money. And I manage a portfolio just as if it was an equities portfolio with excessive due diligence, except the due diligence for these crypto systems are quite different than looking at the balance sheet of a corporate enterprise that's dealing with debt and human resources and capex requirements, opex requirements, so on and so forth. But it's the same rigorous inspection that's required to understand where the opportunities may be. If you think Bitcoin activity continues, which I do, I think Ordinals has shown that the equity, so it's imperative to understand equity. There's the entire Bitcoin market cap is completely untapped equity. It's quite extraordinary. And that's why Ordinals is doing what it's doing. That's why people are paying monumental dollar denominated figures for PFPs. I mean, Ordinals is making Ethereum NFT season look muted. It's pretty gross what's occurring with ordinals, but it's important to peer through the bullshit and realize that's because there's hundreds of billions of dollars of just dormant equity sitting doing nothing. So, what kind of money is the most itchy money? Money sitting on the sidelines. And equity is money, or it's accessible money, which is leverage, so on and so forth. But that's irrespective of the emotional response to a person when they think of, oh, I just got this capital sitting here. What am I gonna do with it? Oh, I could tap the equity. So that's exactly what's occurring to a degree with ordinals. But can you imagine if a credit market comes along? Could you imagine if there was a fork of solidly or a fork of curve, and all of a sudden a 10,000% APR popped up where, oh, bridge your Bitcoin, and it's secured by Bitcoin, and deposited in this LP for 10,000% APR. You're going to get a lot of capital flows, and it starts at the margins. So a little bit of capital flows turns into a massive amount of capital flows, and before you know it, Bitcoin L2s are a hot topic for the same reason. Solana's a hot topic for the same reason. All the credit markets on EVM chains are a hot topic because that's what drives behavior. Incentives, yield, APR, returns, ROI. That's it. It's the driving force of everything we deal with as humans. Find the incentive, and I'll show you the opportunity. Munger said something like that, but it's kind of taken on a different meaning in the modern world, or at least the way we're able to experience it as individuals. Historically, us, you, me, we haven't seen or been able to access these types of systems from a meat space perspective. So go to the bank, borrow some money, do something with it. No, it's all permissioned. You need underwriting, you need a house, you need a type of collateral that the bank wants. Bank's not going to lend you money against Bitcoin. A bank will lend you money against a house. Not going to lend you money against your car, which is fucking weird. It's a goddamn asset. I guess they do lend you money against your car when you take out a loan to buy the car. So that's a loan that's collateralized by the car. You can borrow money against the business. You could borrow money with a home equity line of credit or a business line of credit. So you can collateralize, but it's not thought of in the terms as we've been experiencing as freely accessible equity. Click of a button, borrow against Ethereum. Boom, done. 5 seconds. Click on Aave. Borrow $100. Boom, done. Permissionless. So this type of activity could easily find its way to these chains, and stuff like Celestia's hot. Where's the applications? It's just all it's all hype, and it's the same thing with Solana in many regards because it's all the same goddamn applications. It's all credit and FX. That's all it is, and equity access and board capital, sideline equity getting freaking itchy, especially when there's 20,000% returns slung in front of your face. So that's what causes the behavior. So that'd be very interesting. See a lot of things to be excited about. I'd love to see Matic break out as well. But they all are in the same exact position. Nothing has been invalidated with regard to the Polygon narrative. The Polygon narrative is the Indian narrative. It's a big narrative. And I still qualify Cosmos hubs as the East narrative. I used to say China narrative, but maybe it's the Eastern global narrative. Solana is certainly still the enterprise narrative, and frankly, Bitcoin versus Ethereum is kind of like the secure narrative, and then you'll have the endless argument of proof of work versus of Ethereum proof of stake. But that's like the secure base layer narrative, the established, entrenched, and you have the most security at these levels. So that's my 2 cents. Tapsy's in the house, Juggy's in the house, Robert, Albers. Hola, Captain, soy Dora, never left. Soy Dora. Está aquí. Bienvenidos. Raul, hello. 24 people on the stream, and this is the commentary. We usually got crazy commentary going on. What kind of charts you want to see? What are you thinking? Is the market going to collapse? Is the market going to go up to infinity and beyond? What's the path versus the destination? What are you guys thinking? It's 12 o'clock. We got some time. Pop some thoughts. Happy to talk about anything. Uh, Bitcoin pushed above 44,000 for some time today. Fell back below again. Resistance. It's incredibly deviated from the average price. There's absolutely no reason over the next quarter it cannot mean regress to 30,000. That's literally just what a moving average means. It's very meaningful. So that's the path. The path is, yeah, it keeps going up. Path also is very reasonable for it to mean regress. Maybe even deviate to the downside a little bit, 26, 28, 29, 30, or wherever the hell the time weighted average price is in Q1, Q2 2024. Same situation for Ethereum and especially Solana. It's at 80. It's going to rally. It's going to run. Everyone knows it's going to go to 100, 500, 1,000. Even the big banks are speculating at 2, 3,000. Cool. Then it's going to mean regress like a motherfucker down to the time weighted average price. And let's say 2025, the time weighted average price is 150, 120. Oh, it's going to be an interesting mean regression from 3,000 to 120. But that's what it does. That's the nature of these systems. Period. So please proceed accordingly, understanding these fundamental properties of reality. And mean regression still occurs in the equities markets. It's just that you're not mean regressing at the large time horizon because the structure of the system doesn't allow it to mean regress at those time horizons. But these are much more organic systems than anything that's available in the equities markets. There's no passive flows to these. And that's a good part of it. And there's no vested interests like pension funds and banks that are completely dependent on collateral and equity pricing to remain alive. So you have no systemic vulnerability to depreciation that warrants various interventionary measures. The fact that you and Taiki are filling my YouTube suggested videos again means we are so back. We are back, boys and girls, ladies and gentlemen. These topics, we've tried to talk about them over 22 and 23, but it's nice to see the activity and nice to see people interested in these topics. We were never gone. 22 and 23 was nothing like 18 and 19. And it's interesting that we talk in terms of these 4-year cycles because they align so well with the sovereign debt refinancing cycle, which aligns so well with Satoshi's 4-year halving cycle. And you talk in terms of there's nothing that's coincidence. It's an interesting conversation whether Satoshi knew about sovereign debt refinancing cycle, and he coincidentally made it 4 years to perfectly align. I mean, that's some serious conspiracy theory type shit. and you'll never know the answer to that, but shit. At minimum, it's a hell of a coincidence that those cycles align. Like they're in sync. There's correlation between those cycles. That's downright fascinating to say the least. And that gives us a capacity to navigate these markets, and we know that mean regressions will occur. That's separate and apart from these cycles. The liquidity cycles, which facilitate price deviation from the average to the upside and the downside, and then we act accordingly because we can inspect liquidity, we can inspect credit, we can inspect the price of global collateral, which facilitates the liquidity. We know global dollar supply is going to explode in 2024 because of the refinancing requirements for at least the United States at $10.8 trillion. And because we know the difference between off-the-run and on-the-run treasuries. We know that off-the-run treasuries, stuff that has already been issued, has filtered through the system, has been rehypothecated 1,000 times over, and now it's just getting repaid by the federal government, issuing a new piece of debt, to pay off the old one, and that fresh on the run paper, that brand new treasury, hasn't been rehypothecated yet, hasn't filtered its way through the Eurodollar system. So all you need is the right conditions for the insanity and exuberance of a liquidity flush financial system, and that's dollar down, long end treasuries up, and they start to cut rates. That triggers the destination. That's a forward-looking condition setup for the destination. Along the path still has complexities with regard to leverage built into the system. As I've argued recently, securitization and derivatives become addicted to rate change directionality. Why? Why does that make perfect sense? All right, if everyone sees the rates are going up, they're going to build structured products that are dependent on rates going up. And it turns out over 22 and 23, the structured products, the securities, the securitization of fundamental or primitives ended up selling volatility, as I've learned recently. So the leverage built into the system that supported 22 and 23 literally supported the markets, which is quite disgusting yet fascinating, which also implies that rates come down and may be a forward-looking indicator of a significant amount of leverage built around selling of volatility needing to unwind, which could put a significant amount of pressure on the of buying of volatility. So you could get, but bear in mind, volatility doesn't imply directionality. So if they're buying volatility, what if that volatility is going up? So that would be insane. To my understanding, what I heard on Real Vision the other day was the unwinding of that leverage that could potentially cause the buying of volatility, and what if that volatility is pointing up, combined with 10.8 trillion refinancing plus deficit spending and rate cuts? Holy fuck. We could have not, I mean, the amount of refinancing required globally combined with rate cuts, combined with the buying of volatility precipitously to unwind that leverage, it can have a really wild 2024 condition. Like mega condition. Very interesting to see where the dollar heads heading into like 2026. Now, that's just the way my brain thinks. That's what I'm really most interested in. Because this tells us like the next 10 years what we have to consider. Because if we, I mean, wouldn't that be freaking interesting if we look back in 2030 and the dollar trended towards the 80s and the 70s? That would be crazy, because that means asset prices, particularly the asset prices that are sensitive to liquidity conditions, get repriced not just 10x like Dan Tapiero said in 2030. Everything gets repriced 100x over the next 7 years, 6, 7 years. I literally that's what this line would be. If you have the dollar come down this far and that much debt, new debt gets introduced into the system, and frankly, that's literally projected by the CBO, the Chief Budget Office, or whatever the hell it's called, Congressional Budget Office, where they expect $50 trillion by 2050 would be the national debt, and they're probably an underestimate. You think they fuck up and it's $60 trillion instead? Okay, well, that's where we're heading. So that means a significant amount of currency issued in the system, because debt is currency. The dollar is literally currency made with U.S. treasuries. That's what the construct is. So if they're issuing debt, means they're issuing currency. Okay, so we still have the cyclicality that occurs, but that'd be wild if the dollar does this heading into 2030, even longer, 2035. That means asset prices just go absolutely vertical. That'd be really wild. James, hey man, anticipates Solana DEX volume to outpace Ethereum. Unknown. I think it gets boring at some point, because it's just literally shitcoin after shitcoin after shitcoin. It's just not a. You could sure you can capitalize and engage as many did in 2020 and and that's not something I discount as activity as long as it's rational and well calculated. Uh, the volumes can easily continue. Why not? Um, I would want to capitalize on that volume. I would want to capitalize with transaction fees, and I sit back and I don't give a shit if I'm missing out. I have the structured portfolio I do because of the rules that I've established, and I've determined that the most rational way to engage with the Solana market activity is vis-a-vis the hero position. Pepper Decks will come online, and the entire ecosystem will literally do the work for me, and that's cool. That's fine. And if that comes this cycle or in 3, 4 years, 5 years, that's fine also. Um, and clearly that is right curving the shit out of this whole thing, and I am a-okay with that. If I have to right curve my way to a 10x portfolio by 2030, okay, that's fine. Because then I am not sacrificing my, I don't want to say integrity. There's nothing wrong with being rational, engaging with shitcoins, for lack of a better thing to say. But that's just me. I need to respect this construct and this narrative and methodology that I've developed over the years. Hope that helps. Juggy Captain, roughly what percentage of your portfolio pertains to Solana? Oh, goodness gracious. Hero position's modest. 5, 3, 2.5, 2.5%. I think that is a decent number. That's it. There's nothing else on Solana that I have interest in. I mean, literally, what do I say about what are these systems? You got credit markets and you have FX markets. FX is just AMMs and swap exchanges. Great. I'm not interested. And credit markets are like Aave and lending, and I'm sure there's plenty of that shit going on in Solana, but I can inspect an asset from an opportune price point, but what do I need a credit market for in Solana if I could have exposure on mainnet? And mainnet has the security that we talk about as how we started the stream talking about Bitcoin security versus Ethereum security. So I want the most secure thing for the construct and the size of the portfolio that I have. Hope that helps. Trevor's in the house. John, is real estate going down? It's already been down. Real estate has completely collapsed in China. They are literally papering over their 2008 moment, but they're instead of bonds, it's literally their real estate market. Uh, it's a complete collapse, and they papered over it. Did we expect anything less? Did we expect knock-on effects to the U.S.? Sure, they're papering over it as increasing liquidity in the system. And they probably reached out for geopolitical collusion to say, give us a bone, throw us a bone so we don't completely implode and help us a little bit because China is completely integral to the global order of things. And of course, I mean, literally, Xi went to California. You think he went to California to get some California pizza? To sit on the fucking beach? No, that boy went there for political purposes. And it could have been geopolitical, I don't think it was purposes of security and only. No reason that couldn't have been a topic, but everything is always a financial topic. I'm sure that was discussed. How about that? That's the bottom line. Uh, More robust political system. Felt it could have been the case for them in '08, but we have a more robust political system. Anyway, I think that surmises my sentiment regarding China. Uh, they'll all paper over their shit because the alternative is anarchy and chaos. Financial system collapses, a currency loses its value, and you have chaos obviously from a political perspective. And if it gets bad enough, you have a social chaos that occurs, and no country wants that. So that's why the original Bitcoin talking point of uh, everything ending in default, no matter what, whether it's by actual default or by inflation, the destination remains unchanged. So that's the destination of all of us, of all countries. And now, but Cap, where do we find the mean regression? I see mean reversion, deviation, training view, but no regression. Time weighted average price. But you want a time weighted average price on a relatively long time horizon. Crypto markets don't really give you the yearly. It's just not enough history. It's not like this 6-month chart going back to 1967. You could literally bump this out to the yearly and get a pretty cool chart. It's a hell of a chart. Absolutely. This is my favorite chart. This is my favorite chart. And obviously, like a 10-year and a yearly also is a very awesome chart. Love this chart. I think this chart tells us the future. It's like, this is where the hell we're going. Dollar's going to go down, not because it's supposed to. It's supposed to go up because of all the debt outstanding dollar denominated, but it's going to go down for geopolitical purposes such that the system continues. Time weighted average price. My favorite indicator is not that one. Swap trend by Jagged Soft. That's my favorite indicator. So clearly SMAs are meaningful. 200 EMA is meaningful. 10 SMA, 50, 100 meaningful. But the time weighted average price is like right down the pipe. It gives you that average price. And look what happens when you zoom out to Ethereum on the 6-month. Talking about a time weighted average price of 1100. You zoom out to Bitcoin on the 6-month, you're talking about an average price of 19,000. So you can have big mean regressions. So check it out. If you go to like the S&P, I mean, look at this. Look at the story, the way we talk about crypto of late. Literally 2008 was a mean regression and a deviation to the downside. Same thing with 2000. This is just an index fund, or this is futures. So you can get more history from like a SPX, SPY. But suffice it to say, it's just deviations to the downside, deviations to the upside. Obviously, the structure of the system changed after '08, but still, 10 SMA mean regression, 2016. 10 SMA mean regression, 2018. Mean regression, TWAP mean regression in 20, Q1 20, well, H1 20. Deviation to the downside. It's all the same thing. Are you buying at a premium or do you get a discount? But the directionality is going to hold because the directionality is determined by the desire for political incumbents to actually get reelected and the necessity for social order not to grade into social chaos. So the directionality will continue. So the directionality is an expression of the structure of the system. So that entails once you attain the directionality, it will persist to avoid a social collapse. Very interesting perspectives, huh? Especially when you look at stuff like Russell 2000, same exact thing. It basically looks identical to the S&P from a 6-month time perspective. Mean regression. But look, actually, very interesting. In 20, you get a significantly more pronounced deviation to the downside for the Russell. So this highlights a structural reality of how wealth concentrates. And that's exactly why they talk in terms of the Magnificent Seven right about now. It's just capital's concentrating to the shit that has the most strength. Capital flows from underperformance to outperformance. Something that's outperforming most is going to receive the most capital. And everything else gets left behind. This is exactly why they talk about monopolies. When times get tough, the large companies buy everything. Because this wick right here that you're looking at right here is the non-top companies suffering the most. And what happens when a company is suffering? Their price is depreciated. You get a hostile takeover, or they have to liquidate, or they become insolvent, and then Warren Buffett swoops in and buys them up for pennies on the dollar. So it's pretty clear when you think in terms of what this little line right here means something so meaningful to the structure of the entire system and how people behave and companies behave with regard to opportunism. Very interesting. Hope that helps, Nava. Sir, Joe, President Raul. Cap, can you talk about the potential deleverage that can happen in Q1 2024? It could be not just Q1, Q2. It's really rate cuts. So rate cuts will require deleveraging. of what I've come to understand is derivative products that have as a side effect the selling of volatility. And that has very much supported 2022 and 2023, and that's why we haven't seen uh, significant price depreciation, although rate hikes were the biggest rate hike cycle in history. So that's clearly a perversion of the system, and that structured product, that leverage needs to be unwound. That leverage being unwound results in the buying of volatility, the unloading of that position. Um, the antithesis, the opposite of that position. But the buying of volatility, you can see that'd be really weird. That'd be really weird. Where we can you imagine like a VIX spike to 75 to the upside? What would that even mean? Volatility doesn't imply directionality. Maybe there's something integral to the calculation for the VIX that implies a spike in the VIX is volatility to the downside. But volatility inherently doesn't imply directionality. That'd be really weird to see a vol spike and, just a 20% rip to the upside on the damn equity markets. Okay? Would you be surprised at some freaking weird shit happening? I'm not surprised at anything anymore, to the point where I let the data do the talking. Meaning, if you see the VIX spike to 75 and the S&P rip 20% to the upside, okay, that is telling you what's occurring. That is telling you that volatility doesn't imply directionality. That is also confirming the hypothesis that the VIX doesn't imply directionality, that a vol spike is depreciation. So the data tells us what the market is doing. The charts tell us what the market is doing. The chart points to potentialities and likelihoods of path. The chart tells us clear as day the destination. So the destination implies you don't leave markets. The destination implies a lot of what we've discussed, maybe earliest most in our conversations, that you own assets. And that's what they've been telling us since 71. That's what baby boomers and investment advisors and 401ks have been telling us. So you don't own dollars, you own assets. And you have enough liquidity, you have enough dollars to manage financing day-to-day liabilities. What does that mean, financing day-to-day liabilities? That means going to the fucking grocery store and swiping a credit card for checkout. Just to give, so many folks argue how I speak is not clear, but that's what it really means. Swiping a debit card at checkout is financing a daily liability. It's just important for me to take a step back from my damn brain and clarify these things for folks. I hope that helps. 26 people in the stream, 11 likes. Smack that thumbs up button, please. Hit that thumbs up button. Hit any last minute questions, please. If you have something on your mind, I'm happy to talk about it. But I'm going to wrap this up in a couple minutes. Look at Sal, 81. Let's go to weekly. So it's a breakout from previous weeks. This thing's running. This thing's hot. You don't buy things like this. The reason it's going up is not because of smart money. Believe me not. One of those old time phrases. Believe me not, this isn't going up because of the smart money. You buy a mean regression down to the 10 SMA and the weekly. There you go. You get an entry opportunity on the way up. But don't be surprised in 2025 when you're at 3,000 and you crash to 120. So those are very important time horizons and time perspectives to consider when taking positions and contemplating position size and portfolio composition. So this would be part of the FX portfolio, the cash portfolio as I describe it of late. And I wouldn't be buying something like this. The only reason I own Bitcoin and Ethereum is because we've had it for so long. I mean, we've been in markets for years, so we have. And plus, you're getting cash flow. And maybe that's not the worst idea to denominate cash flow in a high vol asset like Solana. Complexity is portfolio management. I guess with the bridges nowadays, it's relatively easy to take that cash flow and just DCA into Solana, and it goes up and up, and then you FX the shit out of it at 3,000, and you're good to go. It's pretty interesting. Frax got stopped out at the 100 SMA in the weekly, as it is clear as day here. This is why moving averages are so damn meaningful. I mean, moving averages are basically an expression of average sentiment, resulting in cumulative market activity around particular price points. Note 10 SMA, 50 SMA, bullish cross. Let's go earlier. Where's the 50? So we already had a golden cross back here, back in November. So golden cross on a daily, that's meaningful. Where's the weekly? It's, on this chart, at least from a Binance perspective, there is no 200 SMA. That's lovely. So we don't really have that perspective. I wish we had that to see if there was a golden cross on the weekly, but that's nice to see. Golden cross on the daily. Higher lows, higher highs. Directionality reversal. This whole construct is just beginning, ladies and gentlemen. First off, it was a higher low for 2023, even though we didn't have established bullish conditions, which really hit the market with regard to sentiment when you see things like a golden cross. Markets carry momentum. It's not like we're going to all of a sudden hit fresh lower lows and everything's going to fall apart. If the whole macro financial system falls apart, it's forced selling that you need to think about. And forced selling after golden crosses and big structural directionality changes to the upside doesn't imply a return to lower lows and a return of lower low, lower high. It implies forced selling will push you towards a mean regression. Look, a mean regression to the 200 SMA, $6. That's a big deal for this price point. Still a higher low. And there was literally a wick to a higher low in November, and then higher low in September. It was even a higher low in June as compared to 2022. Structurally, the whole trend here, dating back to this low in 22, is up. Higher low, higher low, higher low. I mean, there's no one left to sell below this damn price point. 390. They tried 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times. There's no one left that could. You have to think from a perspective of the average market actor does not sell at a loss. The average market actor sells at a profit, and they will hold until there's a profit. So if you bought it up here, the only reason you sell lower and lower is forced selling, and the average market actor won't force sell because the average market actor is aligned to fundamentals, the enterprise, the value proposition. So if this many times you're not getting back to 390, so that's a very well established low that has been attacked many times. And if you think about the composition of the vested interest, it means you're not revisiting 390s. You can easily revisit a 200 SMA. Let's go out further. Easily is the time weighted average price. So you don't have price targets much lower than probably more or less where we are. Look at this average price. Average price relative to volume. It's $5 and change. So you get deviation of time weighted average price to the downside, big wick to the downside to the 5 and change. That's much higher than the lows. That's pretty damn interesting. I love looking at charts like this. See some interesting things. If you go out to the monthly on a dot, breach to the upside. Told you guys all these charts look the same. Dot compared to Aave is basically identical, even to Atom, just pushing it above time-weighted average prices. Same thing for Convex, same structure. The big activity, collapse, higher lows, and finally starting to push through time-weighted average price is being rejected. These will be late movers. Need to see more established activity on chain, more liquidity, more collateral price action, collateral being Ethereum and Bitcoin. And then you start to see the push up. Matic hasn't run yet either. Same structure, big activity, time-weighted average price, resistance to the upside. Big wicks though. It's very interesting. And this is Coinbase, so there's probably a decent amount of liquidity to see these kinds of wicks. Rejection, rejection, rejection. Break to the upside eventually. Same exact chart. All over the place on the monthly. Quite wild. Last couple of questions, I'll wrap it up. Crypto 2, what do you know or think about the BRC20 ordinal narrative? It's the entire beginning of the stream. So I'm not going to rehash. The entire beginning of the stream is ordinals, Bitcoin L2s, Bitcoin hash rate to secure EVM, and all the potential for that type of market activity. In conclusion, I'm very excited for the potential for Bitcoin secured EVMs. I've been for a long time, and I think the ordinals may finally uh, allow that type of market activity to start to occur. Why am I excited about Bitcoin secured EVM? Because we own those enterprises. Everything you own can be deployed on a Bitcoin EVM. There's no difference between an Ethereum EVM and a Bitcoin EVM. Uh, on the surface, from the application perspective, obviously the consensus conversation, we talked about that. But you could deploy it on a Bitcoin secured EVM, on Rolux, Syscoin, or Rootstock. It's the same exact functionality from an application perspective as you get operating on Ethereum. You're literally going to be using MetaMask and Frame. Same addresses, same everything, just an RPC. Hope that helps. A few months ago, I sold all my Ethereum and bought Atom, and now I saw a lot of upside in Cosmos, but both ETH and Atom price action sucked lately. I feel like the winners of Bitcoin and Solana ecosystem. Okay, so you're late, or you missed it. Uh, but bear in mind, it's imperative to compartmentalize the portfolio. I do not consider, uh, on the surface, Atom an investment. Certainly not Sol, certainly not Ethereum, and certainly not Bitcoin. I don't consider these investments. You could define yourself as an FX investor, sure. That's a trader. And I have the more rigorous narrative that I tell where those types of assets conform more to the cash position. Bitcoin, Ethereum, Sol, Cosmos, Atom, Matic, SIS, these gas tokens, I consider them more of a cash. They're liquid. And sure, you could stake them and you could use them to collateralize a validator, so on and so forth. So it does get a little spiderwebby in that conversation. But they got away. It's not like you would rush to rotate Atom and Ethereum into Solana at these damn prices. You're buying at a premium. And sure, it could mean regress. That might be an opportunity to rotate. If you see Atom with support and Solana mean regressing to the 50s, all right, maybe. But it's not an investment, and I don't think about the portfolio in terms of rotating the FX relatively short term to catch a bid to the upside or catch the run to the upside. It was a miscalculation with regard to what would potentially run. So you have your cash, you have your Atom, which has done very well, up to 1070. Structurally, I love this chart. It's the same chart over and over again as we've been looking at. Breach of the time weighted average price, bit of resistance, and things will continue. The only difference between that and Ethereum is that this is outperformed. Same with Bitcoin. Look at this outperformance. Bitcoin looks very similar to Solana relative to the time weighted average price. Breakout and the run. Breakout and the run, except this had a better retest. Favorable structure here. Same thing. Breakout, retest, hell of a good retest, and the run. It's the same thing over and over again. The trifecta of bullish confluence is the breakout, the retest, and the higher high. So you literally have that here. Bitcoin, Solana certainly has a higher high, except this could literally mean regress from here, and you still have the higher high. Except now you're in a retest of the moving average, and breakout to 87 would be the higher high. Retest, higher high establishes confluence of directionality. Premium versus discount contribute to your self-reflective conversation of portfolio composition and position sizing. Hope that helps, ladies and gentlemen. Concentrator, bit of resistance, but it was a nice 0.382 regression from a fib standpoint. Let's see if it finds support at the 0.5. Very interesting. I'm a relatively large position holder. I'm just going to let this sit. It's up very nicely from the lows in the 70s where I got it. I can afford to let it sit in that regard. It's doubled in price. And structurally, this looks like a great chart. Very large inverse head and shoulders at the bottom. Big breakout. Directionality change confirmed with the breakout. Now we're in a retest scenario. If you see the 0.382 as a higher low as compared to tops of the shoulders, very nice structure. Low volume asset, which means it's slow as shit. So it's a pain in the neck, which means you have to have patience and vision for the destination. But this is interesting price points with regard to where I don't think it goes much lower from here unless there's entirely an invalidation of the narrative, which doesn't make much sense considering there's 58 mil in deposits and it's a 1.6 mil market cap asset. Prisma finding the mean regression. Full retrace to the breakout from the symmetrical compression. Not surprising, considering it's a dilutive asset. It's an emissions-based asset. Same expectation here for things like maybe not so much Aura because that's got fresh lower lows, but certainly Curve Federation and all the derivatives, convex included. I don't expect a significant appreciation. I don't expect a structure of the chart as compared to what we've discussed with cash components of the portfolio, Ethereum, Bitcoin, Solana, Atom, so on and so forth. I expect these to be relatively muted in appreciation. You get a 2x, a 3x here in a year or two. That's kind of my expectation. That's kind of how I break down crypto charts into two distinct categories. These emissions protocol, these financiers. It's a whole category that is not going to behave as other types of assets. I expect muted appreciation, but that's expected. These are cash flow assets, cash flow protocols, sovereign recyclers that mirror historic sovereign nation-state configurations. Very interesting. 25 people made it to the end of the stream. 14 likes. Smack that thumbs up button if you like this content. I appreciate all of you very much. Tell everyone to subscribe. You know the deal. In the description is a link to the most rational community in the entire crypto space. I appreciate every one of you. Y'all have a good one. I will see you later this week. Peace.